G'day expats and welcome to another episode of Expat Chat, episode 140. The numbers are getting up there now. And as always, I'm joined with my co-host, friend, business partner, mentor, the managing director for the Europe, Middle East and Africa region, Brett Evans. Good morning, Brett. How are you?
Well, thanks, mate. Well, thanks. And to the folks on the call, watching, listening, lending us your earbuds, joined with the silky smooth tones of Mr. James Ridley, who's the Managing Director for the APAC region. G'day, James.
Thank you. Good morning, Brett. And I guess today I wanted to talk about, for all our listeners, a little bit about FX because there's been a lot going on in the world in the last 3 weeks. Don't know
Yeah.
if we could have squashed anything more in there, to be honest. So FX has been a big one because we've seen some massive movements on the DXY and the US dollar and I guess the FX rate and how the US dollar is tracking against a lot of other currencies around the world. And I think you and we see a lot of this and I guess how it ties back to Australian expats' overall strategy whilst they're overseas and what they're doing. So I thought what a terrific episode while it's topical because a lot of clients, they've been sending back some funds and sticking to their strategies, which is great to see. And some, have some opinions on whether it's going to get, I guess, cheaper or more expensive on the currency, what that means for their strategy. So I thought, why don't we have a bit of a session on it today?
It's good timing, as you say. And, I'd say out of anything from a financial topic that monopolises expats is currency. Not everyone has property, not everyone has shares, but everyone is always trying to move money. And whether it's money home for savings, money home for school fees or a mortgage or whatever it is, everyone's always moving. So to me, this is always a bit of a hot topic, but I think also too a pertinent topic because what we are seeing in the FX markets right now is incredibly volatile. It's one of those things I think that people are almost shocked at how quickly it can move. I mean, when we saw the dollar get into the fives the other day, you and I were WhatsApping live as it was happening, and it was virtually in the space of a couple of hours. And there's a couple of key causation events that cause the Australian dollar or any other currency to go up and down. But mate, let's just keep the compliance officers happy in the world. Let's get that little jingle out of the way. All the information we're going to share with you good folks today should be treated as informational and educational purposes only. Please do not construe this as financial advice or personal advice. If you do need to get personal advice, please speak to a specialist like Atlas. So, mate, let's jump into it. Why did the dollar do what it did?
Oh gosh, I think when you look at the US dollar, and I think it's more the panic. Everyone was panicking, and it does tie in a little bit to what was also going on with Liberation Day. When obviously Trump, or I should say, it ties a lot into Liberation Day, when Trump announced only what seems like the other day, yesterday, a few weeks ago now, the tariffs. I think you could say that panic set in from a lot of currency investors and even investors as a whole. And often when there's a lot of uncertainty around the world, the things that people flood into, and it's usually some common types of asset classes. Gold is a really common one. Gold's probably peaking now because everyone's starting to get a bit more confidence now that there's that 90-day moratorium on. So you'll see the gold price will probably deflate a little bit. But the other kind of asset classes that they might go into is bonds and then also the US dollar because it's the major trade currency. So when you've got this demand spiking, it increases the value of that US dollar because the demand's there. And then when you compare that to a currency like Australia or the Australian dollar, where it weakened quite dramatically, you're right, 59 cents when I was looking at that night, I was going, oh shit, how low can it go? And then,
Mm.
within, I would say a day or two, it's jumped back up to 61, then 62. Now 63, and I think it's at 63 and a half now. So it's
63 and a
moved
half,
very
yeah.
quickly, hasn't it? When you think about a percentage.
It is. And when you look at on a percentage term, it's a huge move, going from 60 cents to 63 and a half, you are looking at a 5 to 6% jump in,
Yeah.
in purchasing power, which is good for those about to become an expat and bad for those who, well, not bad. I mean, everything's relative. I mean, if it was 74 cents and I said you could get 63 cents, you'd bite my hand off. So, but given where it is recently, and, I think there's a lot of things that move the currency around 100%. When investors hit the reset button, everyone flocks to USD. That's what happened through COVID. That's why we saw 56.5 cents Australian dollars to the US dollar. And that's why we saw that dip recently. There's also a couple of other things that caused the Australian dollar to move up and down. Interest rates is one, and also
Yep.
to commodity prices. So at that time when the dollar was falling, the market was pricing in that the RBA is going to cut their interest rates by 50 basis points in May.
Yep.
So
Monster one.
yeah, exactly. So investors are like, well, Australia's cutting rates, so our effective yield on our money is less, and people are panicking and going to US dollar. We're out. Now that the 50 bips, even though NAB, I think the other day said they got a, they reckon 75 bips. Now they've got the
Oh, that's
90
something.
day. Now everything's been watered down. I mean, the tariff applies unless it's batteries, or tariff applies unless it's electronics, and we'll see a moderating process like we've talked about on the
Yeah,
podcast for the last couple of weeks. Um,
that's right.
we're now getting back to more the long-term norm, from the Australian dollar point of view. Certainly if the RBA pulled out a banger next month and dropped it by 50 or 75, you'd see the dollar go down very, very quickly. But the markets are not a perfect creature, but it's a perfect pricing creature. It reads all these data inputs instantaneously and adjusts accordingly, whether it's currency, equities, doesn't matter what it is, commodities. Obviously, the other play and the other determinant of the Australian dollar is commodity prices. Now,
Hmm.
there's also what could cause the Australian dollar to go up is if we saw an increase in commodity prices. And the only way we'd see that is if we saw some sort of wide-scale economic activity in China, because then they'll
Yep.
need more iron ore, they'll need more resources from us to help grow their economy. So watching this space over the coming weeks and months is going to be interesting to see from China's point of view how that argy-bargy goes between Trump and Xi
Yeah,
Jinping, because that
that's
to
right.
me is going to really govern where the Australian dollar goes. If the US economy flounders, then obviously less demand for commodities and raw materials out of Australia. And guess what? The Australian dollar will go down. As a by the by, I caught up with a former neighbour the other day who works for Donata, which is the freight, or a division of Donata, which is, he's involved in freight. And I said, how's business been going since all this stuff's been happening? And he said, from an air freight point of view, which air freight is primarily urgent goods, pharmaceuticals, electronics, stuff that can't go via sea. And he said
Mhm.
from China, Dubai is the gateway into US. He said it's just plummeted. So it's interesting to see what will happen out of China and how they'll navigate this. But I think, the Australian dollar is back to its short-term medium range, I guess you could say. It
Yeah,
seems to be
yeah,
has been holding here for the last, I'm just looking at the charts here, sort of 63 cents has been even going back to for the 1 year chart, it's around this sort of level. We've just sort of been hovering. I think it got to 68, 69 briefly back in August, September
and
last year.
nearly end of September. Yeah, that's right. It was a bit nearly 70 cents. I was like, oh wow,
Yeah.
that moved pretty quickly. And I think we're even talking about that with clients at the start of 2024 when we're saying, listen, there's more evidence than not to suggest that the Australian dollar should strengthen. And then obviously with the changing of the guard and Trump moving in, and you've seen that obviously all unravel, and we could be seeing a bit of a norm probably for the rest of the year where it's going to bounce around maybe 61 or even 60 cents to maybe 64 cents, I would say. And I mean, us cutting interest rates isn't going to help our currency as we know, but then if we see more stimulus from the Chinese government, that could actually help our currency because you'd think that's going to ramp up their imports and our exports. And the way that the US and I guess China are going back and forth at the moment, we know that's just not good for global growth. I think most economists are revising global growth down to sort of 1.8 to sort of 2.1% from a GDP point of view, sorry, in terms of the global economy expanding. So that's slow, but when you look at historical GDP growth, it's not a massive outlier, to be honest. GDP growth is usually 2 to 3%. That's similar to our economy. It's when you're looking at big economies like the US or China, they can sort of target a bigger growth where they're doing, I'd say, 3 to 4% sometimes. China's always targeting, 4 to 5%, to be honest. They don't always achieve it. And I guess we don't always trust the data that also comes out of China. But
Yeah.
that being said, that's usually what they're targeting. So I guess what we can take from today is that And we're not done yet, but what I want to say is that when it comes to currency, there are so many factors which um, influence the exchange rate. You know, it's not just one, two, or three things. It's a basket of 50,000 different things which impact the way a currency is tracking. And right now, the exchange rate, it presents terrific value if you're in a USD denominated, I suppose, country when it comes to when you're receiving your wages. And it has terrific value right now. So if you're umming and ahhing and, oh, well, do I send some back or do I wait? Well, you know, yep, it could get a little bit weaker, could get a little bit stronger. So that's why we always recommend that dollar cost averaging strategy when you're sending money back to Australia.
And shout out to the lucky people in Switzerland who are earning Swiss francs because the Swiss franc even stronger than the US dollar at the moment. So they're getting some crazy exchange rates when it comes to moving money across there. So, you know, to me, I've always said there's four key risks for expats: currency risk, geopolitical risk, sovereignty risk, and legislative risk. Our job and clients and expats in general, when it comes to managing their affairs, they need to try and manage those risks. If you know that in the next 3 to 5 years, or maybe even longer, you got to head back to Australia, take advantage of the opportunity. That's the biggest thing
Yeah.
we always say to all clients. You don't know, China may unleash the biggest fiscal and monetary policy package ever seen by man. And guess what? Iron ore would rally 20, 30%. The dollar's going to be back at 72. So RBA may not cut rates. The effective yield's higher.
Yeah.
The dollar's going to be up. So we don't know whether today's rate is a good rate until 2, 3, 5, 10 months later.
Mm.
So if you have an inkling, you know, make the transfer. If you're transferring a reasonable sum of money and you're not sure what to do, tranche the money. Dollar cost average it. You know, take today at 63, tomorrow at 62, the next day at 65. Spread that over a couple of months or a couple of weeks. And it just reduces that volatility, that intrinsic risk that everyone has in whether now is the time or not to make that transfer. I think that's what people really find the battle there. They're quite hard on themselves. They go, you know, if I just hold it a bit longer, if it gets to this price, you forget that the FX market is even bigger than the equities market. Again, I think it's 3 or 4 times bigger. So there are that many competing interests in the market that you are a 15th of a rounding error, not even that in terms of in the market. So what it comes back to is making sure that you do what's right by you. It aligns with, you know, what you're doing. Another question we'll be getting quite a bit about this, which, you know, it's not surprising, is people are saying, should I borrow overseas while the dollar's low, send it back to Australia and put that money on my offset account if the mortgage rate is less overseas? Please don't do that. All you're doing is you're magnifying your risk in your wealth, you know, tenfold, because now your debt is in US dollars, your asset is in Australian dollars. So you might make 2 or 3% in the arbitrage between what you're borrowing at and what's going on the offset account. But guess what? If that currency moves 5%, that whole thing not only is blown up on you, but now you owe more and you earn less in terms of
Mm.
on that effective rate of return, because at some point you have to transfer the money back. So yeah, there's a lot of exotic strategies floating around right now with the dollar being low. Um, don't make the situation more difficult, more complex than it has to be.
Yeah, that's right. And I think we're a big believer in dollar cost averaging, and I really think you run too much of a risk when you're accumulating all your wealth in a foreign currency, and then when you're done and you want to repatriate and come home and retire or start, you know, the next phase or next chapter of your life. Maybe the kids are at that age where they're going into high school, so in your mind, that's the right time to come back to Australia. If you're accumulating all your wealth in a foreign currency, everything, savings, shares, 401k, even if you bought a property, you're leaving a lot to chance that the exchange rate is going to be in your favor when you come back, and you could be losing a significant amount of value. We've spoken to a lot of expats over the years who have been very unlucky with coming back when the currency is even stronger or even weaker, depending on what side of the coin you fit, and they're sort of kicking themselves. And then, you know, we've also spoken to expats which have done really well by fluking it, to be honest. It's not a case where it was part of their strategy. They just stuck their head in the sand. They didn't have a plan and they just got lucky. That's not really a strategy at all. It's not a plan at all.
No, it made spot on. And there's a great mantra which we live by. You should accumulate wealth in the country and tend to return to or retire to. By doing it that way, then you're removing the currency risk. When it comes time to leave, your biggest drama is packing up the house and booking the tickets. You don't care what the currency is because everything's been accumulating over successive years back in Australia for you. It doesn't mean that you only invest in Australia. You can invest internationally from Australia, but at least it's AED
Yeah.
denominated and it's all there ready to go and waiting for you. So, and I think, yeah, I think people get the message, is the current price good? Yeah, of course it is. If I said, back in August last year, you can get 63, you bite my hand off. But we don't know what we don't know. And this is a fluid piece and it might hit 61. It might hit 59. It might hit 55. Who knows? But we know that over the long term, 63 cents the US dollar is a very compelling price.
Yeah.
And
Great value.
if it maps to your strategy, then pull the trigger.
Absolutely, mate. We'll leave it there. And for those that are listening in, keep an eye out on our socials. We've got some great webinars as well as in-person seminars in the Middle East as well. Brett, I might get you to talk a little bit about those. You're running those with Adam, I believe.
Yeah, so we've got two. We've got the mortgage and property tax webinar on the 8th of May, which there's an events link down the bottom of the description. You can have a look there. That'll be Jeremy, our head of mortgage, and Ben Turner, our head of tax, talking about benefits, pros and cons, tips and tricks with buying and accumulating property in Australia. And then on the 14th of May, we are running a post-election briefing for Australian expats in Dubai. And then the 15th of May down in Abu Dhabi. So the links will be down below. You can register for those. All very important things coming up. And obviously in those seminars, we'll be covering off on some end of financial year tips as well too, because guess what? 30 June is around the corner. So register for that, guys. And James, mate, we'll look forward to seeing you on the next episode.
Sounds good. Thanks, guys, for tuning in. See you on the next episode. Thanks, Brett.
Cheers. Thanks, mate.